Is the U.S. housing market about to get sick? Are we going to see the beginning of a decline like we did in the stock market and a big sell off and panic amid the sickness outbreak that's engulfing the globe? Hey everybody, JJ here. You're watching Bull, Boom, Bear, Bust. It is March 10th. It is Tuesday. Well, with so many eyes being on the stock market and the big sell off that we've been witnessing over the past couple weeks, we decided to get back into some housing information today. The answer to those questions I presented at the beginning is no. I don't think the housing market's going to get sick, and we're going to talk about why. And I hate to disappoint all my home buyers and waiting out there, people waiting on the sidelines for a market correction, but we're going to try to back up that analysis with some facts and some information here, so let's get into it. Now first, let's look at some bullet points here regarding this topic. Home price increases are getting bigger. There's no panic selling at the push of a button in the housing market. We're going to talk about what that means. There's no fear of shopping for a home, so it's a lot different than retail and many parts of the service sector economy that we have in the United States. Lending standards are getting more loose. Yes, footloose and fancy free on those lending standards. We're going to talk about that. Mortgage rates continue to decline. In fact, they're at 50-year lows right now. And a worst case scenario, the government can take action against taking people's homes. We're going to look at an example of that that's happening right now. Let's go ahead and get started. Now, while we're still waiting for the February housing numbers, let's take a look at the January numbers. This was out of redlendsdailyfacts.com, and it was widely reported, but U.S. median home prices soared almost 7% year over year. January 2020 compared to January 2019 saw an uptick from 249,400 up to 266,300. So home prices are not showing any sign of slowing down. In fact, they're accelerating. And we'll talk about that in a few minutes. But here's a shot of home sales, and we see seasonal upticks and downtrends. But from 2016 up until here most recently, we see this as an uptrend, right? Higher highs and higher lows, right? So sales are not crashing. Money is still flowing through the banking system and into the mortgage lenders. So unless something crazy happens, like they decide to raise interest rates or start to enact stricter mortgage lending rules, then we're likely going to see this acceleration continue. And I say something crazy. Well, some people will say it's crazy not to enforce stricter mortgage lending rules. We'll talk about that in a minute. Also, inventory is declining. Just 1.42 million homes were on the market at the end of January. That's a 10, almost 11% decline from a year ago. Lower inventory, sales increasing, prices increasing, lower mortgage rates. But you say, well, this global outbreak is just getting started. This sickness isn't the worst yet to come, and can't that still affect housing? Well, good question, but not so fast. Let's go back to our bullet points real quick. In housing, we do not see panic selling at the push of a button. What did we just see in the stock market? We saw huge drops in the matter of hours at the push of a button, right? Stocks can be bought and sold in the blink of an eye at the push of a button. Even algorithmic trading played a big part in that stock market sell-off that we saw. But housing is much different. The buying and selling of a home can take weeks, sometimes even months. So you're not going to see the panic selling. And speaking of the stock market, we're going to talk about that in our next report. The stock market could likely bottom out and start going back up before the end of 2020. Yes, believe it or not. We'll talk about that in a different video. But what about the panic, this global outbreak, the sickness, people stocking up on toilet paper and hand sanitizer, events being canceled, people afraid of going to large crowd events like concerts being canceled, people afraid of traveling and being on an airplane with other people? Well, absolutely, all very realistic concerns, but not so much to do with the housing market. There's no fear of shopping for a home. So, yes, you may see people reluctant to be around large crowds, but as far as meeting a realtor and going to shop for a home, maybe a handshake, maybe a fist bump with the realtor, maybe an elbow bump if you're that paranoid. But no, there's no fear of shopping for a home. Now let me expand on that. Some people that are concerned about the overall economy may pull back from looking for a home at this point. I think many people here on this channel are kind of cautious right now of buying into real estate at this point, as I am myself. But remember, most people, I'd say 99% of the population, really don't follow the real economy. And what I mean by that is they may watch NBC or watch their local news and see what's happening with the economy. But if you know the mainstream news, they typically paint things in a pretty rosy picture, even though there is a lot of panic right now being pushed through the media about this global outbreak. All right, so no fear of shopping for a home. Let's talk about loosening lending standards. There's absolutely been a loosening of the lending standards over the past few years. And I'll try to link to this article. This is a report that came out just a few months ago that outlined pretty well about how the guidelines have been loosening. This is out of the mortgagereports.com. And we'll just read an excerpt out of this. Worried about qualifying for a mortgage? You might not need to. According to new data, credit standards are actually loosening, particularly on certain loan types. According to new data from the Mortgage Bankers Association, it's getting easier to get a mortgage. The MBA's mortgage credit availability rose by 2.1% in November. That's an indicative of a loosening credit market, says the trade group. All right, and there's been other articles, but this is one of the better ones that outlines the overall loosening of the lending standards. And we need to ask ourselves, with home prices now where they were before the peak of the housing bubble, is it a hazard for mortgage companies to loosen their lending now? Right? You would think the easiest time to get a mortgage would be when home prices were cheaper right after the housing market took a dive. But no, that's not what happened. They need to get people in at the peak of the housing bubble. Remember, as investors pull back, the push is to get more people to buy in at the peak of a bubble. Could it be the peak? Maybe not. But we know now is the time when they're loosening the lending when home prices are higher, and you want to ask yourself, why that is. Now, the deregulation of the financial industry has even been politicized. We have Bloomberg out there calling for bolstering of the Obama-era financial rules. And it's not just in the United States, it is global. Here's a recent report here out of the Wall Street Journal. Canada loosens mortgage financing rules. And it's the usual suspects. The government is lowering minimum rate used to determine whether a buyer can afford principal and interest payments if rates climb. All right, this article continues. Mortgage brokers and economists say the change would likely add upward pressure on housing prices. Okay, no surprise there. It should be pretty simple to figure that out. Loosening of the lending guidelines creates more demand for housing as more people qualify for loans. More people can throw money into the market that they don't have in their bank account. They can borrow it. And easier to borrow makes more demand. It makes home prices rise. It's so simple that even a caveman could figure it out, right? Let's take a look at our last two bullet points here. 50-year low mortgage rates and government action against taking people's homes. Let's talk about the mortgage rates next. And yes, as interest rates decline, mortgage rates will decline. The Fed, they're going to get in there and they're going to make sure borrowing is easy. Easy money, loose lending, that's the name of the game. Here's the chart here. We see to the far right we are at 50-year lows going all the way back to 1971. Technically it's about 48 years, but you get the picture. So I do expect demand to remain strong in the housing market. Right now, could this outbreak spread and cause such havoc on the economy that even the housing market's going to feel the pinch? Well, absolutely, it's possible, but I think they're going to continue to lower rates to try to combat this. And with the public willing to take on endless amounts of debt, what seems to be endless amounts of debt, I don't see the housing market pulling back before the end of 2020 at least. And let's get into our last bullet point here. Government action against taking people's homes. What are you talking about, JJ? What does that mean? Well, one of the quickest ways to start a population revolt against the government is to start taking people's homes. We saw the revolts or protests anyways that took place in the U.S. after the housing market went bust. A lot of people protesting and Occupy Wall Street. It really woke a lot of people up. When you take people's homes, when you take the roof over somebody's head away from them, it's one of the quickest ways to wake people up. So the government, they could come in and stop homes from being foreclosed, believe it or not. Will they do it? Well, that's up for debate, but it has been done. Let's take a look at a recent example. Italy suspends mortgage payments in wake of sickness outbreak, economic impact on families and small businesses. And this is out of the Daily Mail. So during an election year, I do not think that they're going to let mass foreclosures begin. And I really don't even think it's going to get to that point. I don't think the government's going to have to come in and rescue people and halt foreclosures and things like that because, again, I don't think the panic is going to spread into the housing market like it is with travel and other industries and other sectors. And also with falling oil prices and falling gas prices, you never know. The U.S. consumer may say, wow, look, I'm saving money on gas. Let me go out and buy a bigger home. Right? Sounds crazy, but I wouldn't put it past the American consumer. Where there's credit, there's going to be borrowing and spending and more debt. But of course, if something big and bad happens in the labor markets and mass layoffs begin, this whole picture can change. It won't crash, but we're definitely going to keep an eye on the trends here for you. Thank you for watching this update on housing. Please give us a thumbs up if you like what we talk about here. If you like to support the channel, there's ways down in description. Just take a look down there, please. Or just come back to the channel for more. You do help the channel just by being here. Thank you very much. Ride the bull, prepare for the bear.